All right, let's get right into it. Back in 1993, a brand new product landed on the market, and it would go on to become one of the most powerful financial innovations in modern history. It completely changed the game for millions of investors. We are, of course, talking about exchange-traded funds, or ETFs.
And if you need a sense of just how big this change was, just look at this number. By 2017, the U.S. market for ETFs had ballooned to over $3.4 trillion. It's a massive, critical part of our financial world, and today we're going to pull back the curtain and see exactly how it all works.
So here's our roadmap. First, we'll look at what made ETFs such a revolution in the first place. Then, we're going to peek behind the curtain at the complex machinery that makes them tick. After that, we'll explore the big debate around market stability, and we'll wrap up by looking at a really crucial point: why not all ETFs are created equal.
Okay, first up, the revolution. It all kicked off with a pretty simple idea. What if you could buy or sell an entire basket of stocks, say the whole S&P 500, in a single transaction, as easily as you could buy a single share of stock? Well, that simple idea became the very first ETF.
So what is an ETF, really? Well, you can think of it as a hybrid. On one hand, it pools money from lots of investors to buy a portfolio of assets, stocks, bonds, whatever, just like a mutual fund does. But, and this is the game-changing part, it also trades on a stock exchange all day long, just like a share of Apple or Amazon.
Now, this hybrid design is what gives ETFs their superpowers. You see, with a traditional mutual fund, you can only buy or sell at one price at the end of the day. But an ETF? You can trade it any time the market's open, and you see the price change in real time. And compared to buying a single stock, an ETF gives you instant diversification. All of this also happens to make them incredibly cost-effective and tax-efficient.
And the result of all those benefits? Well, investors absolutely loved them. The market just exploded. It went from just a couple $1 billion in its early days to that mind-boggling $3.4 trillion number. To put that in perspective, today, ETFs are held by about 6% of U.S. households and make up a staggering 30% of all stock trading volume in the U.S. Okay, so we know what ETFs are, and we know they're wildly popular. But how do they actually work? This is where it gets really interesting. It's a brilliant piece of financial engineering that relies on a few very specific players.
First, you've got the ETF sponsors. Think of big names like BlackRock or Vanguard. They're the ones who design and create the fund. Then you have the real engine of the whole operation, the authorized participants, or APs. These are huge financial institutions that have a special permission slip to create and redeem massive blocks of ETF shares directly with the sponsor. And finally, you have market makers who are on the front lines, making sure you and I can buy and sell shares easily on the stock exchange.
And these players all work across two separate but connected markets. There's the primary market. You can think of this as the wholesale market, the back office where APs do their thing, creating and redeeming those giant blocks of shares. But almost all of the action, the stuff we see, happens on the secondary market. That's just the regular stock exchange where existing ETF shares are bought and sold all day.
Now here's the real magic. The creation and redemption process in that primary market is done in kind. That means instead of cash, an AP literally delivers the actual basket of underlying stocks to the ETF sponsor to create new ETF shares, and they do the reverse to redeem them. Why does this matter? Because no cash changes hands, it doesn't trigger capital gains taxes. It's the secret sauce that makes ETFs so tax efficient. So here's the key takeaway. This clever two-market system creates a natural arbitrage mechanism. Basically, if the ETF's price on the stock exchange starts to drift away from the actual real-time value of the stocks it holds, the APs have a huge financial incentive to jump in. They can buy low in one market and sell high in the other, and in doing so, their actions automatically push the ETF's price right back where it's supposed to be. It's like a self-correcting system.
All right, when you have trillions of dollars flying around in any system, you have to ask the big question. What happens when things go wrong, when markets get chaotic? This brings us to the really heavy debate about ETFs and their impact on financial stability. Are they a shock absorber or a shock amplifier? And this isn't just an academic question. It's the central issue that regulators and economists are trying to figure out. These things got so big so fast, but they hadn't really been tested in a massive, full-blown financial crisis. So this is a pretty important conversation to be having.
The whole debate really boils down to something called liquidity mismatch. Here are the two sides. One camp worries about contagion.
They say, what if investors all rush to sell an ETF that holds hard-to-sell assets, like some types of bonds? Could that force a fire sale that spreads panic across the whole system? But the other side says, no, ETFs act more like an emergency brake. Because they keep trading even when things are crazy, they provide crucial price information, price discovery, that helps the market figure out where the bottom is.
And listen, this isn't just theoretical. We've seen how ETFs can behave under pressure. During the flash crash in 2010, the market chaos in August 2015, and that volatility explosion in February 2018, in all these cases, ETFs were hit especially hard. For brief moments, their prices completely disconnected from the value of what they owned, which shows that that perfect arbitrage machine can, in fact, break down when things get really hairy.
There's another risk factor here, too: concentration. Get this, just 3 companies, BlackRock, Vanguard, and State Street, control over 80% of the entire U.S. ETF market. That raises some serious questions about whether having that much power in so few hands could actually make markets more volatile or even block new, innovative competitors from entering the space.
And that variety of risk brings us to our last and honestly most critical point. The label ETF gets slapped on a whole universe of products, and as we're about to see, they are absolutely not all created equal.
A huge part of the problem is just naming. The industry has no consistent way of labeling these things. This can be super confusing and even dangerous for regular investors, because a really simple, boring index fund and a super complex, high-risk product can both just be called an ETF, which totally masks how different they really are.
Now, the good news is that the vast majority of the market, we're talking over 92%, is what we'd call plain vanilla. These are physically backed ETFs. They're straightforward, they actually own the assets they're supposed to track, and they're generally considered pretty low risk. But that other slice of the pie? That's where you find a whole zoo of more complex products. You've got synthetic ETFs, which use derivatives, like swaps, instead of actually owning the stocks. Then there are exchange-traded notes, or ETNs, which aren't even funds at all. They're basically just a debt note from a bank. As you can guess, each of these comes with its own unique and sometimes hidden risks. And the dangers of these exotic products are very, very real. Leveraged ETFs, for instance, use debt to try and double or triple the daily return of an index. But that means they can also double or triple your losses. Synthetic ETFs expose you to the risk that the bank on the other side of their derivative deal could go bust. And we saw a real-life implosion in 2018 when certain products tracking volatility lost over 90% of their value in a single day. And maybe nothing drives the point home better than this. One of the actual inventors of the very first ETF in the US later described leveraged ETFs as being akin to gambling. He said they present extreme challenges for everyday investors. That is a powerful warning. And it reminds us that while ETFs have truly revolutionized investing for the better, not all innovations are built the same.